Hello guys, welcome to my YouTube channel. Today I am going to explain the factors affecting capital structure. So basically what is capital structure? The capital structure combines financial instruments like shares, equity, preference share, debentures, long-term loans, bonds and retained earnings. These instruments helps the company generate funds for its operations with the help of individual and institutions. So basically, capital structure is the required funds to our business. That is some shares, equities, debentures, or long-term loans that we can get from banks or financial instruments, and the return earnings. So, in capital structure. So the first factor is the business size. The size and the scale of a business affect its ability to raise finance. So basically, creditors are hesitant to give them loan because of the scale of their business operations. Even if they do get these loans, they have to accept high interest rate and state repayment condition. It limits the ability to grow their business. The second is earning. Firms with relatively stable revenues can afford a more significant amount of debt in their capital structure. The fixed interest rates businesses with higher income prospect can bear fixed financial charges. On the other hand, companies that faces higher fluctuation in their scale, like consumer goods, rely more on equity shares to finance their operations. The next, competition. If a company operates in a business environment with more competition, it should have more equity shares in its capital structure. Their earnings are prone to more fluctuation compared to business facing less competition. That is, the competition is already market present in market. So basically, competition affect factors for capital structure. The stage of life cycle. A business in early stage of its life cycle is more susceptible to failure. In that case, they should use a more significant proportion of ordinary share capital to finance their operations. Debt comes with a fixed interest and it is more sustainable to comply with stable growth prospects. Creditworthiness. Any company has a reputation for paying back its loan on time will be able to raise funds on less strained time and at lower interest. If any company that cannot pay a proper loan in a period of time, the credit is goes down. So this factor affect capital structure. Control. A management that wants outside interface in its operation may not raise funds through equity shares. Of capital market. The tendency of investors and creditors determine whether a company use more debt or equity to finance their operations. So the state of market is basically sometimes a company wants to issue ordinary shares, but no one is willing to invest due to high risk nature of business. In the case, manufacturer has to raise fund from other sources like debt market and taking loan from financial institution. The taxation policy. The government's monetary policies in terms of taxation on debt and equity instrument are also critical. If a government levies more tax on gains from investment in a shares, more investment may out of the equities. Similarly, if the interest rate on bonds and other long-term instruments is affected due to government policy, it will also influence companies' decision. So the taxation policies also affect cost of capital. The government's monetary policy in terms of taxation on debt and equity instruments are also critical. The risk aptitude management. The attitude of a company's management also affect the proportion of debt and equity in the capital structure. The board member and the other people's attitude is also affect the factors that affect capital. At the end, conclusion is the proportion of debt and equity funds in a company is a dependent on both internal and external forces. Businesses need to keep this in mind while deciding on the ratio of debt and equity instrument within their capital structure. That's it. Thank you.